Welcome to the Professional Investment Podcast. I'm Charlotte Moore, award-winning journalist and co-founder of Moore Squared Communications. Each week, we welcome a guest to the show to share their news story of the week. And I'm delighted to welcome Veronica Humble, CIO at NatWest Cushon, to the show this week. Welcome, Veronica.
Thank you, Charlotte. It's a pleasure.
Great to have you on the show. Do tell us, what is your news story of the week?
Well, the news story of the week should absolutely be the pensions minister address at the PLSA and his plans for the pensions industry, which is absolutely great. And we are very, very supportive of that. But I think the interesting bit there is that there's clearly a desire from the minister and from the government overall to speed up the developments in the pensions industry and make pensions industry invest in UK productive assets. And it will be really interesting to see how this plays out. But I think overall, it's a really, really interesting position. I think this will help the industry, and I think it will be very interesting from the investment side as well.
Yes, and after all, we are the Professional Investment Podcast, so we do love to talk about investment. But before we get into that, I think both you and I were in the room last week when Thorsten Bell was presenting. And it's fair to say that he was true to his Scandinavian roots, wasn't he? He was fairly robust with the industry. But I felt, talking to other people, that they actually almost welcomed that attitude and welcomed having somebody who really is deeply marinated in pensions and understands it so well. It's the first time we've really had that since Steve Webb. Would you agree?
I agree. I think deeply marinated in pensions is a great way of describing it. I will adopt that for my personal gain. So first of all, I actually have to admit I'm a bit biased here because I'm a huge fan of what Thorsten Bell was doing before. I'm a huge fan of Resolution Foundation, and their reports were for a bit my bedtime reading, which probably tells you way more about me, and not necessarily in a good way. But I think this is really interesting, and I think he understands the industry, but also like the demographic trends that the UK is facing. And he kind of understands the orders of magnitude, which actually very few people surprisingly understand. So it's interesting, and I think it will give the industry the right push and accelerate some of the processes that were already underway. Again, I'm a bit biased here because we have been investing in private markets and UK productive assets for a while. So we actually have 15% allocation to private markets, target allocation to private markets in our headline default strategy. So we welcome this. But at the same time, we know how long it takes to develop things. We seeded UK's first LTAF, but it took ages for the industry to come together and to progress this. So I perfectly understand the impatience from the minister and from the government, who are basically saying this is not good enough with this space and with this pace. It will just take us forever to do anything. So it doesn't mean that we need to do things very quickly, because pensions is definitely not the place to kind of move fast and break things. We have people's life savings. This is not something that needs to be broken at all. So we need to be very careful and very, very clever and very thoughtful in what we do. But at the same time, we just don't have the luxury of very, very slowly moving towards a distant future.
So when you said that, you think that Thorsten Bell understands the orders of magnitude. Could you flesh out what you mean by that a bit more?
So He just understands the demographic trends because, again, the Resolution Foundation did do a lot of work on this. So they did a lot of work on the intergenerational transfers and intergenerational picture of financial assets. So we all know that kind of basically newly retired people closer to retirement, there are a lot in that cohort who have DB pensions and generally by and large are fine. Younger generation, 20, 30-year-olds do not have DB pensions unless they're in LGPS and very, very few remaining open DB schemes. We have to do better in terms of the pensions industry, and definitely the attitude from the government and from the pensions minister is the way to do it is also to provide better returns and better value for money for our members. And that's one of the reasons where the private markets and particularly growth equity is coming in.
So you mentioned there that you're already investing in private assets. There was quite a lot in his speech that he covered, including talking about LGPS and consolidation within there. The government has also talked about consolidation within DC, but obviously the main impetus for all of this is to encourage as much as he can of the different pension pots to invest in private assets. So talk to us a bit more about what you are doing with that 15% allocation to private assets.
Yes, of course. So we have 15% target allocation, as you said. So about a third of it is with private equity, about a third is renewable infrastructure, because we are driven by the climate opportunities and risks. So climate transition is something that we are focused on, and that's again kind of very aligned to government agenda and very aligned to their views on infrastructure. And the rest is kind of assorted private debt, natural capital targets, and will also actually be hopefully venture capital. So that's something that we're working on. So I think one of the things that is interesting from that perspective, it's not just you go and invest in private assets, like what types of private assets and why. And we're coming, as well as the government, from the point of view that these are both productive assets in terms of helping the UK economy, but also fundamentally these are higher risk, but also higher returning assets that can benefit the members. Both from point of view of diversification, because like it's a huge space that in your standard kind of global equities portfolio or your balanced 60-40 portfolio, you just don't have access to. So, and from purely diversification perspective, that makes a lot of sense, but also kind of from the expected returns perspective and risk-adjusted returns. One thing that I have actually been thinking about a lot recently is like we know what to do, by and large, what to do in pensions with assets and with strategies approaching retirement. And what we as pensions industry do incredibly well is saying that, well, our focus is on the defaults, which is fair. You know, as a master trust, we also have like high 90s% of members invested in default, but also, and kind of about 90% of assets invested in default. So that's great. Kind of, we're really focused on the default. But then members often are invested, but they don't know that they're invested. And we kind of, as an industry, we're all saying like, we'll look after it. So we're really focused on this. We'll run the money well, but then we'll give it to you in 30, 40 years' time. In a way, the question is, how do we make it work for members now? Because that's something that is potentially it presents a bit of a communications challenge, and no wonder some younger members are possibly disengaged with pensions, because if they don't know what the money is doing for them, and this is something which is 30, 40 years far, far ahead of where they are now. Like, why would they want to spend any time on this now? Whereas actually we know that they should, because they should look at their finances and possibly contribute more, or at least kind of feel good about what they do with their pensions. So one of the benefits of private assets and private equity and VC is that you actually get really, really tangible stories that can be very, very engaging. So even actually outside of private equity and VC, we have renewable infrastructure. So we have about 100 sites across the UK that we invested through one of our funds. And again, that's something that you can see. Or another investment that we have in our portfolio is a renewable energy focused pepper farm. It's like literally they're bell peppers that you can buy in various shops, and you can literally eat your pension, which I think is something that we should all aspire to.
I agree with you on that side. I mean, that was always the benefit, because my background is as an investment analyst and I worked in equities. And the benefit of equities, before we dehumanized it in a way by talking about passive, was that equities is about buying companies. And that's why active managers have always managed to sell so well, I think, because they had stories to tell. I have chosen, handpicked these companies because they're going to give me, I like these companies, and you could talk about the companies individually. And by doing passive, which we did in a very kind of like technocratic way of sort of like talking about beta or not alpha and exposure to the market on a financial, rational sense, that appeals. But when you're trying to build connection with scheme members and people who actually hold pension schemes, it becomes much more difficult to sort of tell a story about the S&P 500. And private assets, as you say, opens up that narrative structure again, when you can talk about eating your pension or coming to visit, the wind farm that your pension scheme is investing in. It makes it much more tangible and much more real for people. It's always been the challenge, hasn't it, about fixed income? I mean, how do you make bonds and duration? And we have a long relationship, Veronica. You're one of the people who explained duration to me whilst holding a canopy on a rooftop. So there's how do you make duration realistic if we don't all have the benefit of having Veronica explain it to us whilst holding a canopy on the rooftop? So, that is always a challenge around investment. We have these very esoteric, obscure things, and the more real and tangible we can make it to people, the better, right?
I totally agree. And interestingly, we have been doing some work with Evershed Sutherland, the law firm, on interpretation of fiduciary duty. Says she, immediately going into pensions, hardcore jargon. But the outcome of that is that trustees should be thinking not about just purely financial side, purely numerical side of expected risk return characteristic, but also what does it mean for the standard of living of their members and the world that they are retiring into. And that is both true from the point of view of communications, so you can make it tangible, but also that allows for looking at the investments from a slightly different perspective, because fundamentally, great, we have increased the expected return by or expected pot size by 3%, and yet the cost of living or kind of medical costs in the future have increased by 30%. Is it a good outcome for our members, or not an amazing outcome for our members? And that's where the sort of productive side of investment can actually really come in. And if through pensions, through what the government is trying to do, we can kickstart or provide more financing to the areas that can actually tangibly impact that standard of living, that will probably be a really good outcome.
Yeah, and I mean, that goes back to the point you made right at the beginning about Torsten Bell understanding the orders of magnitude. And it's a point I like to make many, many times on this podcast, so it's good to make it again. I do feel a lot of the problems we have in the world today and the rise of populism and geopolitical fracturing has to do with the fact that we have massively aging populations, but nobody is really thinking through what that means. And that is an issue, because it means that aging population is going to suck up more and more of the public sector costs. And obviously that burden falls on a smaller and smaller group of people to provide the tax revenues. And if you see a lot of the issues that's happening, even with the Labour government's current spending review, that's really reflected a reflection of that demographic trend sort of unwinding over time. It's something that's going to happen over a long period of time. So anything we can do, as you say, to ensure that by the time people who are 16 who retire in 40 plus years time actually have some kind of growth and not a planet that's burnt to a crisp is good, right? And that's something that you as a CIO need to balance against making sure you also make money over the short and medium term.
No, absolutely. And I think the importance of pensions, private pensions, will become even more evident as people age, because I think that was the point that Karen Ward of JP Morgan made as well, that, we take for granted the level of support the government gives right now. I think a lot of 20, 30, 40-year-olds now understand that actually they can't by default assume that it will be the same in the future, which means that our savings and our pensions investments, not just savings, will play a much bigger role in the future. So we should really, really think about them more.
So let's talk a bit about venture capital, because we know that the government is very keen to encourage pension schemes to invest more in venture capital within the UK to help bolster economic growth. I mean, as a political aside, I find it quite hilarious that we have a government that's banging the drum about venture capital, banging the drum about economic growth, and keeps ignoring the fact that if we rejoin the EU, it would be very easy to achieve that goal. But let's put that to one side. Can you talk to us about how you feel about that, moving more into venture capital, and what you at Cushon are thinking about doing there?
We're very positive. I think from just like very high level member perspective, if you think about it, the timelines are aligned. Because DC members typically will have a fairly long-term time horizon. Actually, they will have typically a super long-term horizon, 20, 30, 40 years. So long-term, 10 plus years, venture capital, and particularly deep tech, all these technologies that are very much emerging ones, this is something that pensions should be invested in. And should be benefiting from as well. And we see a lot of really positive examples in the US with all the university endowments, and actually some pensions, big pension schemes as well. So it's a well-trodden path, not in the UK. Whereas also in the UK, yes, the market is much smaller. We're still third largest VC market in the world after the US and China, but also there is a real gap in financing. There is a gap on kind of every level for VC, for kind of smaller end of PE, for then kind of this next level of PE. And we hear a lot of stories how, the companies, when they fall within those gaps, they will, for example, just kind of try to bootstraps themselves in until like a larger PEs come in. So this means that there are several years of very slow growth instead of having the right financing and just growing as they can. So we are working with two potential venture capital managers, Future Planet Capital and British Business Bank, with a view of hopefully making investments later in the year. I can't speak for trustees. So obviously they are the fiduciaries. They will make all the decisions. We're supporting them, and we're working with the managers to make it investment ready, and with our investment consultants as well. So as usual, pensions industry is very well protected from that point of view, but it is a really exciting space. And we think that will be massively beneficial for DC pensions.
So talk to me a bit maybe about the sort of the structure and the operations of it, because I know that you're not this size, but if I were a typical 25 billion scheme, my kind of like minimum allocation to any asset class is probably going to be around 5%, because it's not really worth my while investing a lot of time into something unless I'm going to allocate 5%. 5% for a 125 billion scheme, and you'll correct me if my maths is wrong, I know, Veronica, is about £1 billion. So is there enough liquidity? Is there enough in the pipeline within the UK? And of course, we don't have to allocate just to VC. We don't have to allocate just to the UK. How should pension schemes be thinking about that kind of allocation to VC? Where should they be looking regionally, and where should they be looking along that investment curve from startup to large buyout on private equity, and where does VC fit into that?
So I'll go to the last question first, because I think we should think about the whole stack, because again that aligns with the members' time horizons, but also overall we should probably try to give the members the access to just the whole industry, and from the diversification point of view, from the returns point of view. In terms of the allocation, I would actually disagree here, because I think everyone who's thinking about this will be thinking about kind of diversified private markets portfolio. So separate allocations there will be smaller than 5%. And if our goal is to build out properly diversified, well-positioned private market sleeve, then you will have lots of different things there. So currently we do have 5% target allocation in private equity, but it consists of also different sleeves. So there are different ways you can do it, but we are looking currently at about 2% allocation to a venture capital, in addition to the 5%, around 5% allocation to private equity. None of this can happen straight away. So all of these are target allocations that will be built out gradually. So I'm totally with you that if you say like tomorrow we allocate 5% or even 2% to asset class X, which is illiquid, newly emerging with new managers, like it can't happen straight away. So you need to make sure the plumbing work, you need to do all your due diligence, they need to find the correct investment opportunities if you're going through different managers. So it is a process, and we're working with our trustees, we're working with our investment consultants, who also are emphasizing that this is a process. So we're also growing quite fast. So whatever we're allocating now will be a smaller percentage later on. We just need to get on with it. Right?
And are there particulars, and within that, so regionally, we have had a sort of a system where things need to be diversified globally. That's definitely what we see on a passive equity allocation, where we go for MSCI World, or even maybe MSCI ACWI, maybe for some people, which takes in the whole world universe rather than just developed markets. How do you do that with a smaller, lumpier, spiky thing like venture capital and private equity? Is it important to have that same level of global diversification, or can you move away from that?
That's a really good question. I think there are different schools of thought on this. We are very much in the school of thought that we are happy with UK overweight. There are several reasons for that. So one reason is actually that legal opinion I mentioned earlier, because if you think about what will be additive to the member standards of living in retirement, that is definitely more UK than the world. Same thing about infrastructure. It is great to build infrastructure in US or somewhere else, but actually it's the UK that will benefit the members from kind of overall standards of living perspective, and particularly if we're talking about energy transition, again that has real consequences for people living in the UK. Same with venture capital. One thing that I would also highlight, we obviously have better access to UK opportunities and better connection with UK managers. So again, that probably is reflected in fees and the way we are working with the fund managers to come up with the structures that are more DC friendly rather than the global managers who just have massive clients and to whom even 25 billion UK fund probably is not top 3 of their clients. So we're working on this, and I think that specifically in private equity infrastructure and VC, overweight to the UK is justified. Also, you need to step back and think about your portfolio holistically, because still kind of UK DC probably will get to somewhere between 10 and 30% allocation to private markets. The rest will still be public markets and will still be typically more globally diversified. So if you're thinking about your geographic allocation, probably thinking about holistically also makes sense. So more overweight in private markets is not moving the dial massively on the overall portfolio.
Okay, and sort of just one final sort of question on venture capital. Is there a particular sector, industrial sector in the UK? I know you're going to be open to all opportunities, but we probably have, like, for example, we're pretty good at life sciences, but I know that that's quite risky to fund. Is there a particular sector that excites you, or do you want to keep a very open mind when it comes to venture capital within the UK?
We will definitely keep an open mind and actually rely on the fund managers to keep a diversified exposure to different sectors. So again, British Business Bank and Future Planet Capital that we're working with are looking at their portfolio, and they have their targets, and they have both regional and sort of sector allocations. But at the same time, again, you have your point about the member connection, and I think new emerging technologies, universities, life sciences, this is all very exciting, and we can make it really interesting and appealing to the members so that they feel good about their pensions and that their money is working on something really exciting.
So final question for you, if I might, Veronica. I mean, to go back to the beginning where we started talking about Torsten Bell, government has talked a lot about consolidation. It has said that it expects DC member schemes to be around 25 billion. I think that's sort of approximately 4 times bigger than Cushon is today, because you're about 7.5 billion, if I have that correctly.
No, it's smaller, but...
okay, but okay, more than 4 times. Maybe you have to... So how are you thinking about that? I mean, how do you feel about that? That would you have to squish yourself together with 4 other master trusts? Or are you trying to say to the government that small too can be beautiful and it can be innovative? And is there a benefit to being smaller? And what can you do? Even help the government out maybe with their venture capital opportunities if 15% of your portfolio is a much smaller pot of money and we get away some of the problems that we mentioned before. So Is small beautiful, and should the government be thinking about that, reflecting on that in their sort of mad consolidation drive?
So I would probably say not small is beautiful, but growing is beautiful. So I think that the point about scale is valid, and I think there is definitely some elements that are coming with scale, but it's not necessarily that level. We are quite comfortable with our growth ambitions and growth trajectory, but you're absolutely right. There is also nimbleness that comes from being a smaller challenger fintech provider that we're definitely seeing on our side. So we have a very close relationship with our trustees and our advisors in a way that is very, very productive and allows us to actually innovate, probably on a slightly shorter time scale than some of the competitors. We're excited to be in that space, and we're definitely comfortable growing.
Okay, well, I think that's a great place for us to end our discussion. Veronica, what a delight it has been to have you on the podcast. This is the penultimate episode of the second series. Next week, we will be at the final episode, but never fear if you're addicted to the Professional Investment Podcast. Series 3 will be starting towards the end of April, giving everybody, including me and my guests, a nice break over Easter. Listeners, I hope you've enjoyed the show today. Please remember to hit the subscribe button so you never miss a show in this series or future episodes, and do engage. Put your comments on underneath whatever form you're listening to. Make sure you engage with the poll if you're listening on Spotify. And all I can say is thanks again to Veronica, and thanks to all of you for listening.
Thank you for having me, Charlotte.